Well, again, hello, welcome everyone. We're going to start. This is Glenn Thompson checking in. Glad you're all attending, and I just hit the recording button, so in case we miss anything or you'd like to review and after the initial hearing, or if you were not able to actually tune in and attend, if you subscribe, we are recording today's presentation as we always do. As you see on the screen, my name is Glenn Thompson. I've been working as a mentor with Pacific Trading Academy since the beginning, almost 16 years. So it's and we've been doing the webinars now for, I guess, 2.5 years, almost 3 years. And glad to do it. Always happy and interested in presenting the latest results of research that is relevant to the markets day by day. You can contact us at the information you see, 800-339-8588, if you'd like to know more about the programs and what I do in particular. Again, Peter Newman is the person that handles internal affairs and any arrangements. Sometimes he puts me in contact with you if you have specific questions, if necessary. I'll have plenty of time at the end of today's presentation for questions, but if I can periodically check on the side panel of my screen, if you have any questions that are relevant to the topic, please feel free, and I'll do my best to address them. Today's topic is trend analysis, the power of trend analysis. It is central to the analysis of trading. I always come back to it. There are many things, but trend has become a cliche, at least from the analysis part of trying to locate good trades. So what's this all about? How do I think of it, and how do I incorporate it in my analysis? So let's move on and find out. And I have an array of slides that I think will at least hopefully in some way address this issue. There are, I guess, as I see it, two major forms of thinking about the identification of good trades. One is to work from what the topic of today's presentation is about, from the vantage point of a trend. And what is a trend? A trend is the direction of in this case, the market. In a broader sense, it's the direction of the system or an object. What is its orientation? And that's essentially at the very broadest and most basic of levels, trend analysis. Then there's everything else that we can look at. So there is this, as I call, or think of it as a polarity. There is this pull between two opposite types of analysis that you and I and all observers of markets that are trying our best to profit utilize and draw on to enable us to get some advantage over the other, our co-traders and our co-investors, or co-conspirators in crime, as it were. So trend analysis is more or less the practical application puts us in a position to follow. We are trying to observe and ascertain what's the type of motion of a market, let's say. And if we can do so, if we're successful in that endeavor, if we can accurately and objectively identify the type of motion, and essentially there are three basic types, up, down, or sideways. If you're looking at a market in these days in 2016 on a flat surface, there are only three types of major motion, and the market can go up, down, or sideways. So if we can define that, I start from the analytical view of thinking that a market's most likely going to keep on doing what it's doing, and that's a consequence of a foundational principle of all of life, all of our universe, the first law of motion. Systems, objects, markets, you name it, tend to continue their type of action or state because that's the thing or the state that requires the least amount of energy. And so I put myself in a position to follow. If I can identify a market and I observe that it has been in a certain type of motion for a certain period of time, my initial thought is to work from the idea that it's going to continue with that type of motion. Now, the moment I shift my thinking, it's almost as if I go to the other side of from east to west or north to south, and look at and consider all the other forms of analysis. All of the other forms of analysis, other than the pure trend following mode or paradigm, are geared and constructed and applied and thought of and used to try and enable you and I to forecast and anticipate what's likely to occur. So there's this intrinsic divide between the two types of analysis, the follow versus the anticipate, kind of stretch or spread between these two types of analysis. How do we reconcile two opposite types of analysis is a key point. How to converge the polarity. Well, here's how I do it procedurally. I always start working with the assumption that if a market's moving with a certain type of motion, it's most probably going to continue to do so. I continue to follow up until my anticipation, that is my forecasting, indicates otherwise. So all of the methods and models and indicators, everything you can name other than pure trend analysis, is designed to give you a sense as to a possible or a probability of a certain type of change occurring. If you feel it's valid, then you're going to anticipate that and gear and set up for that strategically. If you don't, by default, what you're expecting is that the market in its current path or trajectory is most probably going to continue or persist. And so that's the paradigm or the dynamic that we've got to constantly kind of shift between or run a shuttle between in terms of our thinking in our head. Shift internal state from follow mindset to forecast mindset at the point where you felt you have a critical threshold of evidence to suggest that the market is more probably going to shift out of one mode of behavior or type of motion to another. After it's shifted, you revert back to the following mode. So there's constant shuttling back and forth between the mindset of follow versus the mindset of anticipate, back and forth. So how do I more precisely do this? Let me just check any. Good, loud and clear. I'm glad. If there's any questions, I think please, again, on the right side control panel of your screen, write them in and I can address them so that you're following along as best we can here. All right. Let's illustrate this a little more explicitly. So I want to talk first to kind of put this into a broader context. What constitutes a trend? What's the essence of trend? What is a trend? A trend is a phenomenon that is due to something repeating. What's the most basic form of repetition? Exact. And what does exact repetition lead to? Exact repetition leads to symmetry. What is symmetry? Well, there are a number of definitions for symmetry. Essentially, an object or a system that is symmetrical or has the property of being or of a symmetrical component or property is that property embedded or intrinsic to that object or to that system, which lends to it the ability, if that object is adjusted or manipulated or shifted or altered in any way, the alteration, the adjustment of the object or the system doesn't affect its appearance or its relationship. Your visual, your perceptual keys to understanding that object, let's say, or that system, are not altered in any way in response to the adjustment or the change of, let's say, of position of that object. That's not quite precise, but that's the best thing that comes to my mind at the moment. In other words, if you take an object, or if you were to adjust or move an object, let's say a chart of a financial market, a stock you're looking at, or some financial freely traded market, and you were to adjust it somehow, shift its orientation in space, or on the screen you were observing it, if your observation of it after or subsequent to the adjustment leads you to reach the same conclusion, in other words, your interpretation, your walk-off or carry-away interpretation has not been affected by the adjustment to the underlying system, that is a consequence of what we call being symmetric. The most symmetrical geometric object I'm aware of is the circle. No matter how you adjust it, whatever adjustment or alteration, you are not able to differentiate. It still maintains its exact state. Your perception of it remains constant regardless of, or regardless of any adjustments you could make to it. If you were to rotate it, if you were to shift it, if you were to translate it along a plane, if you were to lift it out of a plane, whatever. So it represents the circle as a geometric configuration or object or figure represents the standard of infinite symmetry. Everything else has a certain amount of symmetry, but that is the ultimate infinite symmetry. Well, you might say, well, what is my little sidetrack discourse here on a circle and the symmetrical properties of a geometric figure have to do with making money in a financial market? Well, it turns out that persistency of a dynamic system, and so when we're talking about a stock, a commodity, a forex currency pair, any freely traded market is from a very deep way, or to generalize our conception of understanding, if we can think of it as a system. It's dynamic, and it has properties of dynamic that other dynamic things have. And it's a system that we study on a timeline. It's changing as a function of time, or its properties and its state change as a function of time. There's the past, there's the present, there's the future. Behavior in motion that is symmetrical, to the extent it has higher and higher amounts of symmetry, is the extent to which you, the observer of that dynamic system, a system which is changing, are not able to discern a difference between, say, the past, the present, and the future. Okay, so that's the standard. So the essence of trend is something is repeating. It could be anything in the real world as we move from the theoretical to the tangible. There is a repetition of buyers buying at a certain price. There is a repetition of sellers liquidating at a certain price, and variations on from there. But if this repetition or the repeated phenomena is exact, that's the most basic form of repetition, and a consequence of exact repetition is it leads to higher and higher or greater and greater amounts or degrees of symmetry. And again, symmetry in this sense is the state of the system regardless of, let's say, if we are able to distinguish past, present, and future along a time axis, a horizontal dimension of time, which is what we are doing when we look at a price-time chart, a price-time plot. Most of the time is what we're doing. If you are unable to distinguish the state of it at say the past versus the future, that's a market, we say, which is in a period or a midst of a trend. Okay, and that is a result of some underlying phenomena or a collection of phenomena that are repeating. The more exact the repetition, the more symmetrical the behavior, the more probable that market in the real world will keep on it exhibiting that symmetrical component, which a practical real-world consequence is the trend will persist. Why is this important in a practical sense? Well, by the way the process of financial speculation has been geared and created and set up, and the way it persists is you establish a position which, if aligned with a given trend, a byproduct of this in dollars and cents terms is you generate a financial return. So anything and everything we can do as speculators, as investors, that will serve to maximize the amount of time your positions you've established in a market are in direct alignment with the trend, the symmetrical component of that system, that market. Anything from A to Z, be it a stock, be it a commodity, a derivative, you name it, on any time period. To the extent we can max the time that your position is in direct alignment, we will correspondingly, that will serve to maximize your financial return. So that's why this is, from a practical way of thinking of it, important and helpful to us as traders. All right. So that's the underlying theoretical motive or imperative or factor that serves to create trends. All right. We can get very mathematical. I won't get too far into this. This is work Jim Sloman and Wells Wilder created this. Ultimately, they didn't create this. This ultimately is a consequence of the first law of motion and many it's geometry that derives from it, or stems or is a consequence of the first law. And it simply means that it's the inertia of an object or a system. But we can make it objective in a geometrical sense. We've stated in the previous slide that the second reflection, or I didn't state it explicitly, so I want to state it now. What I want to say here is that the second reflection is the market's own prediction of the highest probability of where it will go in the future, continuously updated. So what's the second reflection? Well, the second reflection is referring to two rotations, one around a horizontal axis. Think of a coordinate plane, a Cartesian coordinate system. Just think of a flat surface, and you have your vertical axis, typically denoted or labeled as your y-axis, and your horizontal, the time axis, let's say, your x or axis, your ordinate and abscissa. All right. So what this slide is indicating is action in the past over here, and if you can see the mouse, folks, these little letters are just indicating, let's say, they could represent hypothetically price points. J, I, H, G, F, letters of the alphabet representing different levels or states of a system that's dynamic. This vertical dotted line represents the present moment or now, and so everything to the left is the past, everything to the right is the future. So to the extent, if I want to, with this principle, which is an outgrowth of the symmetrical componentry of a trend, a trend in motion that serves to persist always has or creates what we call the second reflection. The most probable outcome of any trend will always be, from a geometrical interpretation, it will result in what's called the second reflection, which is one reflection which is around the vertical axis, 180 degrees. That's just a rotation of the phenomena. So if you were to take each of these points in their position in space in quadrant number 2, which is a position in the past, and rotate them 180 degrees around this vertical axis, they would all wind up as a mirror image in quadrant number 4. And that would be considered the first reflection. The first reflection is the second highest location in space with respect to time of a dynamic phenomena, such as a price return. All right. However, you and I, as speculators and as investors and traders, are interested not in the second most probable ending point for a price. We want to know the best, or the most, or the highest probable location. And it requires a second reflection for various reasons, and it primarily due to the symmetrical componentry of what is underlying a trend. You would require another rotation, this time 180 degrees, around the horizontal axis. So if you started in quadrant 2, your initial reflection or rotation would be 180 degrees around the vertical. And that would end up with a second, you're going to get the silver medal. You're coming in second place. That's the second highest or second most probable location for the price to end up, given a persistency and a certain amount of embedded or intrinsic symmetrical property inside of that system, let's say. If, however, again, the market or the system you're studying has a higher degree of symmetry, it will more likely affect another reflection. And the second reflection is another rotation of 180 degrees, this time around from whatever quadrant it's in, around the horizontal axis, and it would end up in quadrant 3, and that's a consequence of this property. All right, let's move on. That's just the theoretical component here. This is just an example of stock market persistence. One of the basic features of a trend in standard trend line analysis is to have what we call a trend line, and so you use a linear instrument to help us understand and gain clarity on a nonlinear system. A line is simply a linear approximation to attempt to kind of contain and gain clarity on a more complicated system, which at times may be linear, but at other times may have a mixture of nonlinear behavior. And so the basic theory of trendline analysis, which is a starting, it's a basic, granted it's a very rudimentary and not quite a perfect approximation of the system we're trying to study, but you require at least two connections. So if the market's rising over the course of time, as you shift your gaze and observation from left to right, you want to require, you're looking to draw a straight line connecting the pullbacks from, or what we call the bottoms, and those are the excursions away from the trend. So if you have two connections, if you need to draw a line connecting 2 points, or that will facilitate the drawing of a straight line, you must have 2 points. So if you pick a starting point, say a bottom, and then you connect it to another bottom, we have what we refer to as a tentative trend line based on standard trend line analysis. With the connection of a third, you confirm the trend line, or confirm rather the trend. And so this is just an example. This is an old chart. It doesn't matter. I just wanted to illustrate the persistency. In this case, it's the stock index, the broader stock market. And at this point, you started the line. You had a tentative line once you saw a pullback deviating, or rather market's excursion away from that persistent symmetrical behavior. But it's consistent with this tentative line. You extend that outward in time and space. The third time it connects, if it does so, and you can see that it did over here in July, if you can see the timeline here, it is a confirmed line. And that will lend on the continuum of probabilities a greater likelihood for expecting similar behavior or price action of persistent of like kind and out forward into the future. And we saw that to be the case. So this is very standard. As simple as this is, it's a very effective and useful tool. Simple trend line analysis, one of the very first things I ever learned. Let me take a moment. I want to make sure, are you still there? Because I'm not getting any feedback. Are you still here, able to hear? Let me just double check. Thank you, VJ. Appreciate it. Okay, I think this is pretty basic. I almost decided to forego this very basic idea, but it's, sometimes things are quite simple and rudimentary, but they are nevertheless relevant to the systems. Markets tend to be very complicated. Every now and then we have very basic ideas and tools that are appropriate for even in the midst of a complex system such as a market. So that's a very simple concept. Let's move on. Same idea, just that was just our computer department put a little trend. Okay, now remember we have this constant shuttling back and forth in our head. Are we in the mindset of following? Do we want to get on board a system with the expectation it will persist, and if it does, that will serve to meet our financial objectives? Or we understand, however persistent a system is, it's not indefinite. It doesn't last infinitely into time. History and precedent and experience tells us that. Markets don't keep going up forever, nor do they keep going down forever. At varying points in time, a system changes its character, it shifts. We have a trend change. Technicians refer to those points on a chart as tops and bottoms. An economist would refer to that as zones of excess supply if it's a top, or zones of excess demand if it's a bottom. Same underlying phenomena, different titles or words, but it's the phenomena that we're interested in. So there have been, for the last 150, I dare say 200 years, all sorts of ideas, models, relationships, indicators, indications, clever tricks by which you and I as observers can figure out when will the persistency of a given trend end and be more likely to give way to a completely different type of price behavior. That is to say, when is a market going to stop going up and start to go down, or stop going down and start to go up, or affect some type of fundamental shift in its behavior? Well, for example, one of the things, I use a circle, a geometric technique. I alluded to this a few minutes ago. A circle is the most useful, or in a practical sense, geometric object in terms of a number of different types of analyses that I perform to enable me to anticipate in terms of price and time when it is I expect a market's going to change some feature or component or attribute of its behavior. One of the components of a circle, one way in which I use a circle, is the point on the circle that would correspond to due east will often correspond to a time point. How I draw the circle is of particular importance. These are the types of things that and there are a couple of different ways. Very often I'll identify important what I call thrust, and the thrust will represent the radius or the diameter of a circle. But suffice it to say, for our purposes now, given certain particular modes of construction of circular objects on a chart, there are various portions or parts of the circle: the circumference, the radius, the diameter, the center. All of the components that make up a circle lend themselves in useful ways, often quite profitable and quite reliable ways, by which I'm able to know in advance or anticipate when a trend is likely to change and a new trend is likely to mark its onset or begin. So you can see this is a chart, I don't even know, this is going back, where this point was a reversal point, the point in time. If you were to draw a line tangent to the point on the circumference, I didn't draw it, I could have, but I thought it was clear enough and obvious enough. If you were to draw a vertical line tangent to the point on the circumference of a circle that was, say, due east, very often this will mark a point of change or a trend reversal point, as was the case shown in this chart. So the question is, when do you have a sufficient body of evidence analytically to indicate or suggest to the observer, to you and me, that it's time to abandon a given change and that you have an accumulation of offsetting forces that are sufficiently appropriate to enable and facilitate a shift in the type of behavior of the system? And critically, that is the critical key that determines whether or not a system was going to maintain a persistency of a certain type of behavior or be impersistent and shift its mode of motion. So a circle is one of the things I look at. This is just the bond chart, a 30-year Treasury instrument. It's an old chart, again, just reflecting how useful a simple trend line can be in delineating whether or not a market's still in a given trend or has it shifted its mode of behavior. Again, the basic tenets of a simple trend line. This is TA, or Technical Analysis 101. You must, to draw a line, you must establish 2 points, a starting point, and you run it through a second point. If you have those 2 points, you have what we theoretically refer to in all of the basic tenets of TA, Technical Analysis, a tentative trend line. If you draw and extend that line out into time and space, if it connects with a third point, that confirms the theory and that justifies the line. And you, to a greater extent, have greater confidence that you can place in that line, serving as a watershed acid test mark for the trend. Depending on how the market, once you have a confirmed trend line, you can watch the behavior and observe the behavior of your market relative to that line. As long as it stays within the confines of that line, you can assume, based on this simple form of analysis, the trend is in effect. So you can see over here at the right side of the screen where the trend ended by a violation, or as a result of a violation where it broke through. Here you had the start of the line, you had a tentative line when it connected, here's your third connecting point. And all the way through here, essentially, is you can assume that trend was in motion. Even in the pullback, even when it's moving here, you interpreted that contrary retracement as just that, a pullback, but within a broader generic bear market. Once the market clearly over here had evidence of breaking to the other side, that's an indication from the simplistic trendline analysis that in all probability there has been a shift of the behavioral underlying components of that market from a downtrend, in this case through the end of the screen, sideways market. So that's very simple, but yet applicable and powerful and relevant and helpful idea. Okay. Same thing. This is a Forex example, dollar Swissy. I don't even know. This is a weekly chart. Again, a starting point. If you're in a downtrend, you always connect the tops because you're interested in the deviations from the motion which constitute the primary translation of price. In a falling market, clearly the net primary motion is downward. So any price action in the opposite direction, that is to moving upward, is contrary. As long as the tops that form are conforming to a trend line. So you can see here's the starting point, here's the tentative trend line by virtue of the market respecting this line. At that point, I have 2 points enabling me to draw a basic trend line. You have what's referred to again as a tentative trend line. With the formation of a third, it's confirmed, and you can assume as long as the market stays within the confines of that line, the downtrend is in motion. So any and all price action in a downtrend moving to the upside, as long as it does not take out at what we would call or think of as a confirmed line, you still interpret it as an opportunity to go short. If you're already short, you could consider adding to existing shorts. If you're on the sidelines, it would be an appropriate time to sell the pullback. Go establish a short position from an advantageous price position, utilizing this acid test line as your kind of water in the line or line in the sand, as it were. All right. Same thing, Forex persistency up until it wasn't. Here you have more or less from a bottom here. Now, this is actually not drawn correctly. Here is the tentative line, and not so much. I don't know why. This is not the perfect example. Nevertheless, it does. There's clearly an obvious sensor trend, but not quite strictly adhering to the letter of what I saw. So let's move on. All right, this is an old chart, but here connecting tops in a downtrend. Again, the rule is in a downtrend you connect tops because those are the deviations from the net translation downward of price. In an uptrend, you're connecting, as you go from left to right, a succession of higher and higher bottoms. And as long as the bottoms don't violate that trend line in a rising market, or vice versa, as long as the tops don't violate your trend in a falling market, you assume that the trend is still in motion. All right, so here's your starting point. Here's the tentative line. Here's the confirmation with the third point. And you can see here it respected it perfectly, like clockwork. Here it respected it perfectly, like clockwork. Here it somewhat broke through. We'll see, or in the future that would have been telling. Let's see. All right, and you can see what happened. This is still going. This is a continuation of this slide here, and it broke through, but continued to persist. Again, evidencing the power of the inertia. It takes an awful lot of energy to enable or to get a system that has built up a stream of momentum or inertia, if you will, off of that track. Not saying that that doesn't happen, it does. Anytime a market shows a turn or graphically illustrates a top or a bottom, it's an indication that there has been a sufficient amount of energy of the right type and of the right intensity or frequency to enable it to shift its type of behavior. But it requires that. Barring that amount of proper intensity or energy of the right quality and type, it's not, the system left to its own devices is most probably going to keep on moving in the same direction as has been the case. So turning point triggers. That is the fundamental things in the world that serve as the agent of external force that impact the market, let's say. What are they? Well, there's a myriad of them. There's infinite number of things that we refer to as fundamental that could serve as catalyst or trigger to bring about change in the market. Thank you for still being there. Any questions? All right, good info. Trend lines better than other kind of technical analysis. I wouldn't say better. They may be, they may not. Good question, Seth. I don't know that I would give them high marks from the vantage point, just their ease of understanding and ease of application, simple to identify, yet disproportionately relevant in terms of the degree of reliability that a trend line, a simple application of trend lines to a financial market on a chart, let's say, of any market on any time frame, will render for you is disproportionately good information with relative to the amazingly simplistic idea. So they are one of, if not the oldest form, or certainly in the top 2 or 3 oldest forms of analysis, going back over like 200 years. The only thing of older than trend lines might be candlesticks. I'm not sure. It's either candlesticks or trend lines, but suffice it to say they are going back, not to antiquity, but going back since the beginning of organized financial trading about 150, 200 years ago. Yet, and now, the critique, why I might, the limitation of trendline analysis, remember, we are taking an intrinsically linear tool and applying it to a system which at times has linear components, that the periods when it's trending, but at other times admittedly moves into modes of nonlinear action. So it's not a perfect tool, and that's the obvious limitation. It is by design linear, and we are in principle applying a linear idea, the graphic manifestation being literally a line drawn on your chart one way or the other on the screen, and applying it in an attempt to highlight the linear components of a system that is more or less a hybrid. At points in time it exhibits linear componentry, at other times it's more nonlinear, and there's an intermixture of those behaviors. So it's not a perfect tool. Nevertheless, in the scheme of things, I give it high marks, even though I recognize its limitations. Here's the only other thing I would add to that is, in comparison, I don't want to delineate a given trend or the probability that a given trend will persist or not persist solely on the basis of one idea, relationship, or application. You typically, in all forms of analysis, will acquire a more reliable takeaway of understanding of the state of the system at that juncture, given an aggregate of different types of ideas. And as such, here we have certainly by no means an exhaustive list of things that one can apply and look to and utilize to determine that maybe a given trend is more likely going to end and peter out and allow for the onset of a new trend. Here's a list of things that I tend to look at. It's certainly, again, not exhaustive, but it does carry, I've tried to find different things around the compass, very different things. The idea of all analysis, we want to certainly incorporate different types of tools that are all designed to generate or to derive the similar type of information, so that when different tools line up and converge and reinforce and corroborate, they're in agreement, which is not all that likely due to the inherent difference of their construction and their sensitivities to different markets. But when it does, however infrequent, that's when we clearly understand it's a stronger indication that the agreed upon output is probably, we can imbue it with more confidence and reliability. So W.D. Gann said, when time and price balance, the market will turn. What did he mean by that? Well, it's when a market has moved. I don't want to get too far off into Gann analysis because it's a form of analysis, polar opposite trend. It's one type of analysis. But the school of Gann and all the varying types of ideas that he presented to the world and he used in his own speculation is very in-depth. One of the deepest ideas that I think, a kernel of a concept that he was championed many in the early 1900s was this, he equated price and time. He found and saw reason to see the equivalency of at a very deep level. So when we look at a price chart, any time frame, any market, what this idea is saying, we normally think of price action. You see vertical bars or candles or however you're presenting the returns or changes in one level of supply and demand, and where buyers are willing to buy and sellers are willing to sell, and we draw pictures of it on a price chart, and we see the historical motion of that system, and we're able to extrapolate that out into the future. And that's one of the premises of general technical analysis based on inertia, again. Okay, but a deeper way of thinking about it, vis-a-vis what Gann was saying, is that you're looking at time and price. When the changes that you see when observed and thought of as a change in price is a consequence of a certain amount of time. In other words, there's a time, or rather a price correlate for a certain specific amount of time elapsed. That's a primary premise of Gann ideas, or the thrust of one portion of his analysis. A market's going to do what it's going to do once it has moved a certain amount of time. There's certain specified cyclical amounts of run time for a system such as a financial market. There's more of a universal application. This applies to other things, but insofar as it's for our purposes in speculation and in trading, I want to confine our discussion to financial analysis and financial systems, stocks, bonds, commodities, you name it. What he was saying is, having run in a certain way with certain attributes that are characteristic, say, of one of the three major types of trend, up, down, or sideways, for a certain specified amount of time, on the spectrum of probabilities, it's more likely that that system will change. Well, even if we are not privy to and even if one is not is lacking an insight as to the explicit reasons why. In other words, I don't know the cause and effect of the change. I can still appreciate correlation. If I see that X% of the time, 75% of the time, when a market's moved more or less from one point, a top to a bottom, and it's taken 90 periods of time, say 90 days, minutes, weeks, months, etc. 90 happens, I'm not picking that number out of the air. That's an important amount of runtime for a system in motion, important from the vantage point that when it completes, that system, for varying reasons, is more apt to change some, if not all, of its features, or their attributes that shift more probably after a object or a system has been in motion for 90 units of time. What's a unit of time? Any amount of time elapsed or ticking off of a clock. So Gann said when time and price balance, the market will turn. So that's one of the things that I would be cognizant of and pay attention to, that if I am currently in the present moment in time observing a trend that seems to be persistent, up, down, or sideways, if I determine that I am getting close to a balance point where time and price would balance, that would be one thing that would suggest, aha, I ought to get my intellectual, my cognitive shuttle ready to shift my mindset from one of following to one of anticipating. It's just one. I'm not probably insufficient, but when put together in a group with other factors, each one having their own special sensitivities to how markets can behave. What's another? Oscillator divergence. That's very simple for those of you who are familiar with it. Classical or candlestick reversal patterns. Fibonacci harmonic retracement levels. We're all, well, you may be, you may not, I don't know. Fibonacci ratios and certain amounts of runtime based on certain Fibonacci numbers that comprise the sequence. Multiple Elliott wave embeddings, for those of you who are familiar with Elliott waves. Cyclical or cycle period endings. These are all some, again, certainly by no means exhaustive, but some of the types of alternate forms of analysis, all of which are arbitrary because they allow me to get a sense or acquire a sense, when effective, as a greater than average probability that a system that otherwise has been in motion in a certain way for a certain time is more probably going to shift and move into a different type of motion. So when I have an accumulation of these types of things, it's a greater than average indication that we are about to change, and I want to be shifting and getting ready to shift out of following mode to anticipation mode. So here's an example of a very simple form of one of the previous types of indicators, divergence. Here we have a chart that you can see has been rising for a period of time, a clear definitive trend. I've just outlined the end of the trend here, where you have two tops, a top here and then a higher top. Here's a standard oscillator, I think it's a stochastic, and classic divergence, you have a top corresponding to the initial top here, and then the market moved from a given top to a higher top on its line. Here you have a lower top, the classic standard divergence, you see. Very simple form of analysis. And that could be one type of indication suggesting, aha, even though currently the current state of affairs is the trend seems as if it's going to persist, I am building a body of evidence more likely suggesting if I pass that threshold of sufficient contraindication, maybe this system is more probably going to stop moving in one direction and mark the onset of an alternate type of behavior. So that's an example of simple divergence. Same thing. Oh, actually, this is different. This is an extreme. This is actually a system or an idea that I developed more than 10 years ago using a simple RSI, and through certain behavioral features of a trend. This is a natural gas chart coming down. Here we have a bottom. From left to right, it's coming down. If you look from this bottom, everything to the right, the net motion is up. At what point is this still just a temporary retracement within a broader generic bear market, or should I imbue this bottom with a greater amount of importance? Is it marking the end of the bear and the start of a new bull? Which one is it? Well, again, all sorts of ideas and tricks and relationships have been thought of and applied and used to help us delineate between those two. This is an acid test moment. Where's the point? We have to make a trading decision, and our money ultimately is a consequential byproduct, or whether we make it or we give it out is determining on some of these relationships. So based on certain behavior and criteria that I developed, I came up with one way, an acid test way to delineate, should I interpret this rising price action out of sync or asynchronous with the preceding motion? Is it just a temporary one and another series of pullbacks, or should I interpret it and imbue it with greater significance looking to go long? Opportunity to sell and add to an existing short, or alternatively opportunity to establish a new long? Which one is it? So we have another way of using a standard generic tool to figure that out. Again, standard divergence here. I won't belate the point. This is simple. A trend that had been in motion clearly for an extended period of time. You had a bottom, lower bottom, corresponding bottom, higher bottom on the oscillator, more indicative of a higher probability that maybe this thing is about to reverse in a significant, tangible sea change type of manner. Another, okay, old trend or new trend. Make new friends, keep the old. One is silver, one is gold. I just remember that. Thought it would be an old nursery school rhyme. But again, utilizing my circle technology, often I'm able to more precisely delineate changes in trend. However reliable it is, it's not by itself. I always want to have a collusive, I want to work any given idea and utilize it in concert with alternate ideas, and that serves to acquire or enable me to capture greater and greater degrees of confidence that I am interpreting the market correctly. All right. This is a recent chart. This is printed out last night. It's an hourly chart of the stock market, the E-mini S&P, clearly evidencing the simple trend analysis that I've indicated. You started at a bottom. If you're rising, if the net translation of price is rising, by definition, a simple trend line should be drawn connecting bottoms. You're connecting the points of excursion from the primary motion of the trend. If it's a rising trend, the primary motion is up. Falling trend, primary motion is down, by definition. So when you're drawing a trend line, you simply connect the points of extreme excursion away from or deviations from the primary direction of mode of motion. So those would be bottoms. So you want to connect a succession of higher and higher bottoms. As long as that pattern of higher and higher bottom formation persists, based on the tenets of simplistic and the theory of a simple trend line, you can work on an assumption that that trend is still in effect. So, because the question always, consciously or unconsciously, will present in your head, whether you know it or not. This is a perennially thought of, reflected upon idea. When I see this market form a little top here and it starts coming down, does that mean it's the end of a uptrend and the start of a downtrend? Well, depending on the time horizon that you anticipate and plan to be in that kind of campaign and that market's motion. So we have to put it into the context of the expected or projected amount of time and that you're in the trade, which in turn could partially, if not completely, be a function of your objectives and your style of trading and what you like to do and how you like to do it. That said, to generalize this, again, this is an hourly chart. This is just showing from last week, the 3rd or the 2nd. That was actually about just a week from today. Not a week from today, a week ago today, actually, from the bottom on the 2nd, last Tuesday, through where we are yesterday evening. This was printed out, I think, last night at about 10 o'clock or so, 10:30, 11, I'm not sure what time, but you can see the fluctuation. Markets rarely move in a straight line. Life is not so linear and perfect. Life tends to be sloppy and messy and erratic, often having an asymmetrical stair-step-like structure to it. But nevertheless, you still, as the beauty and power of a simplistic trend line is that it simplifies and enables us as technicians and observers to make generalizations, at least in a broad sense. Granted, we lose some precision of detail of information, but that's the price we pay. The benefit we acquire is, at least in a general clarity of what we can, how we could best, where are the odds, how should we most probably apprehend the system for profit so as to improve our odds for financial success. So I started with a bottom. You have a tentative line or a trend line. Once you have connected to a second bottom, the third bottom connection and respecting confirms the trend line. So you can see, I kind of drew that incorrectly. It didn't quite come up there. But essentially you can see the market in its pullbacks or deviations from the motion consistent with the primary trend are respecting this simplistic form, this linear approximation to a very complicated system. And as such, it still tells me the takeaway of this chart on an hourly chart. I can do it on a 10-minute chart, a 60-second chart, a tick chart, or a 100-year chart, and all time horizons in between. The takeaway is this thing is the motion of the system, which is rising, is still in effect. And as such, my most probable course most probably acquire return to my equity is to establish a long position of some sort. That's all it tells me. But I have a degree of reliability and confidence attached to that based on the simple form of analysis. And again, the theoretical reason for this is it requires an awful lot of contraindications. Now, that happens from time to time to violate this trend. It's a pure energy consideration. Something has to happen in the world. Something or things must occur. New phenomena must occur of the right type and of the right frequency. Frequency connoting the implicit, the magnitude of the volume of energy present to enable a system or to jump it from one type of motion to an alternate. Barring that occurrence of the phenomena that have the right type and amount of energy, a system left to its own devices is most likely going to carry on in the lowest energy state, and the consequence of that manifested is simply to persist doing what it's doing. So the trend line confirms I should be, if I'm already long, stay in my long position. If I'm on the sidelines, think in terms of, if I want to figure out directionally what's the most probable course, currently, based on the behavior of the past and a symmetrical component embedded in the market, it's most likely going to keep going. That's all it tells me. And unless and until other forms or indications or phenomena occur that would offset that, I'm in following mode at this point. All right. This is a very specific form of analysis. It's basically a Gann idea. It's this is one of the simpler of his ideas. Often his ideas are quite complicated. This is quite simple, but quite relevant. Not all forms of analysis that are powerful are necessarily commensurately complicated. Some are, but whenever I am aware of a very simple idea that's quite disproportionately relevant and effective, I want to certainly examine and test and apply it if it works. And it's simply observing the behavior. History tends to repeat. That's another tenet of technical analysis. Not always perfectly, but at least often in a semblance of similarity. The future, that which has been, shall be. History in all realms, not only is applied to our investigation of financial systems and markets, but in a broader sense, but certainly applied to specific stocks, bonds, commodities, any freely traded market. So, this is a chart I printed out yesterday. This is a recent chart of September crude oil. It's just an energy market, a valid market. You could make the argument oil is the most important commodity on the planet. The whole world, in some extent or to a large way, is dependent on it. But in any case, here's the analysis I want to present. Clearly, from this bottom here, back at the beginning of the year, January 20th, I believe, to be exact, if I recall that date, through this top, the net translation of price is rising. No rocket science required there. And so there are two basic charts here from everything from the beginning in January through the top here, clearly a bull rising trend, but you could say everything here is a bear market, clearly. Two distinct different characters here. But here's the point I want to make, and it's a very simple form of analysis. At whatever point when you were trading, let's imagine you're sitting here on the top of the chart, or any point in a few days after, and you start to see motion deviating from the top. The question will always arise, whether you're aware of it or not, if you're paying attention to what's going on and we're effective in doing our job as observers. What to make of this contrary motion? Should I interpret it in retrospect as this being the ultimate top, the end of the crude oil ascent, or is it just a temporary one and another of series? You can see historically there've been periodic market didn't go straight up to this top in one straight line. There was a nonlinear back and forth stair-step-like formation. So in the first week or so after the market hit the top and declined, what to think of this? Is it just another in a succession of retracements within a broader bull market, or should I imbue this with more importance? Is this the end of the bull and the start of a bear? Which one is it? Well, we don't want to be arbitrary. We want to have some collection of objective analyses and applications which will enable us to have a corresponding amount of confidence in the answers we derive. Why not allow the history to serve as a proxy for the future, is Gann's idea, or one of his simple ideas. So what I did here is I measured as a metric each of the historical corrections for the period of time from the bottom to the top. And there are all sorts of variations on this analysis. You can do it, you can normalize it, you can use a log chart, you can use a semi-log chart. I didn't want to complicate it, I just wanted to present a basic idea. But the idea is measure the magnitude of each of the discernible salient corrections, both from the standpoint of time and price. They are the two they are the axes upon which the system is observed and running through and evolving forward through time. Okay, so in other words, what I did is from this top to this bottom is 9 days, and it represented a change in price of $5.81. Okay, that's one of the corrections that was obvious, that stuck out to me. This top right here to this bottom was a lesser extent, only lasted 6 days, and it was a smaller change in price change. These horizontal lines represent the magnitude in terms of price. The time was just, I wrote it in text-wise. Okay, so this is one correction. Okay, this is another correction, a little less in time, a little less in price. 6 days, and changed the level, the delta in price was just over $3. Here is another correction, 5 days duration, $2.93 in magnitude. Okay, here's another correction from this top down to this bottom, 11 days. You can count them, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Final day, 11th day, correction. And the magnitude, change in price, I just did the simple subtraction. This is very simple. From the top to the bottom, change of $5.68 in change value, loss of value of crude oil. Okay. From this top to this bottom, 3 days duration, change in price $4.67, and then for this top to this bottom, 7 days, $3.74. So I just highlighted, in this case, 6 of the corrections from the period in time from the bottom in January 20th through the ultimate top here, whenever that came in June, middle of June or whatever, or first week, or nearing between the first and second week of June, let's say, at the top. So the question is, and it always will be, in one way or other, at some point in your analytical process, again, if we're being thorough in our analysis and not just arbitrarily establishing positions, we want to define the system. Having defined the system and having acquired a modicum of confidence that your assessment of the current state of the market is correct, you're then in a better position to trust in your projection or extrapolation of that current state out into the future. If you have confidence and trust in your future forecast, you're then able to select a strategy more suited for that forecast and projection. That's the whole, in a nutshell, cursory overview of the process of speculation. But here's what I did. Allow the historical tendencies to serve as a reference for the future. and I could do so in one dimension or two. In this case, I did two in a very basic way. I simply added up and got what's the average magnitude of correction in the history of the rising market, both in terms of days and time. So I added up 9 days to 6 days to 5 days to 11 days to 3 days to 7 days, and I got my total, and I took the average by dividing by 6. And my average time for the correction from the beginning of the year through June for the last 6 months, the average time that the market spent in corrective phase was 6.8 days. So I could round that off to 7 days, but it actually came out to 6.8 days. Okay? The average correction magnitude, the degree of correction, came out to $4.30. So those become, at least based on the market, historical componentry of the past of the system itself. Let that serve as a standard reference by which we can at least attempt to approximate evaluating the future. The moment so any and all correction, any and all pullback off of a top, not meeting this or less than either one of these two things. Now, how you do it specifically, that they can all sorts of variations on the actual interpretation, but at least we have some objective data usurped or extracted from the system itself. In a sense, we're allowing the market to be its own best arbiter of how it's most likely going to behave going in the future. What better indicator is there itself than the market itself, than to itself? It's self-arbitrating, or it's providing its own internal commentary on how it's most probably going to behave, and offering it up to the astute observer, you and I. Okay, so the moment you see a price action deviating from what you would define to be the primary trend, which up to this point was rising market, okay, the moment you see a decline in price exceeding $4.30 and or lasting longer than 6.8 days is the moment you would begin, if at minimum, question, I wonder if what I'm observing is something other than another of a succession of pullbacks in an otherwise generic bull market. And so that becomes a limiting line in the sand, if you will, analytically, that would cue you into the greater possibility where time and or price have overbalanced, and what you're seeing is it's not still maintaining the balance from the vantage point of either price or time. And the moment you see that is a moment you should say, aha, on the continuum of odds, I am seeing price action more probably inconsistent with a previous trend, more consistent with what is marking could be very well the onset of a new trend. You have a greater indication to reverse your short, go establish a long, or if you're on the sidelines, establish a new long. So the next slide indicates this. The very first time we had a pullback here, and I think that was 1, 2, 3, 4, 5, 6 days, very close. And I don't recall, and so that would have been a clue to possibly watch and see, but it did not exceed the reference acid test, 6.8, or you could round it up to 7 days, but very close. I'm starting to think, by the way, I left this on because that's a Gartley. That would have been an indication. That's completely separate idea. But by the time we had this pullback from this top down to this bottom, is it referenced by the red arrow, if you can see the trend line, that had exceeded in both time and price the historical tendencies of the market, and as such it was more objectively a clearer indication to establish, or at least at minimum to change your view. I am no longer as strongly holding and interpreting this price action when the market's dropping as a retracement within a bull market, but more probably it is consistent since we have exceeded the standards of the historical tendencies while the market was rising. More likely it suggests we are in a new mode of behavior. The market is more probably shifted from a bull to a bear, and as such it's more appropriate to consider the short side of the position, which if you had, in this case, anywhere in here, you can see the subsequent price action. This was printed out through last night. And so we have the basis for more objective analyses, and in turn you can more likely acquire a more appropriate strategy suited to generating and maximizing your return. This is the same idea. I didn't do the arithmetic in soybeans. For those of you agricultural traders, this is the daily chart of soybeans. You can see the entirety. You had ample history. It didn't go straight up from. You can see the period of sideways motion which from a directional standpoint I'm not interested in. If you're selling volatility, yeah, but that's a separate issue. But if you can see we rose and a pullback, rose, pullback, rose, pullback, rose, trend, pullback, and then up to the top. So you have, let's see, 1, 2, 3, 4 clear salient historical pullbacks that can serve as a reference. So when the market hit this top, we see in retrospect, not knowing it at the time, and you start to see it exceeding it when it did, you begin to acquire, you have the basis. These vertical lines represent the, these are the, I actually marked off the points where they would, where you would know. These are the corrections. Oh, the same thing coming down. If you're at whatever point you went short, you wanted, these were the magnitude of the pullback in a short market. This is the top and the pullback. You can measure them. And so if you're short at any point after the market hit that top, you got short, and then you can see the market right now, recent bottom, and for the last few days we've been going up. At what point do you exit your shorts and go out and go long? Well, you use the magnitude, measure the retracements while the market was going down. There are periods of excursion away from that, the rising motion, the contrary motion. When you exceed the average of, say, in both time and price, that would be an indication more probably you ought to shift your view. So that's just one example of how we can shift, or what would be possibly an imperative to shift from the following mode to shifting to the alternate anticipation, and that's more closely correlated with a change of primary trend. This is one last example. Forex. This is an hourly chart of Great British Pound, GBP, USD on an hourly chart, just exhibiting the trend line simple analysis from a top. Here's the tentative top here, and it respected, here's the third top right in here more recently, earlier today, or actually this was last night. Here's again the initial top, tentative top, confirm the trend line top right here. So as long as this price action stays, as long as the pullbacks or retracements, in this case since the primary trend is defined to be lower or moving down, that's the primary direction of motion or translation of price, any and all counter motion to the upside, as long as it respects this line to the extent I'm expecting so, I am interpreting this as within this time window as a downtrend, and as such I want to be focused more wholly and initially on short strategies. This other stuff is just complementary oscillators and things like that. So it's just another example of a different asset class of Forex pair on a different time period. Same ideas, simple ideas will apply. Same. Any questions, folks? That concludes today. Let's just see. For those, someone's asking, can we send you a recording? To get that, I'm not sure of, I think that we may, I don't know if we send a copy automatically of the recording to everyone who's subscribed, whether you've been able to attend or could partially hear and didn't hear the entirety of the presentation. But one way or the other, yeah, I know we have the recording in our archives at our site, so if you get it, great. If not, you can contact us again at 800-339-8588. The website again is www.pacifictradingacademy.com, 800-339-8588. Again, Peter Newman handles all questions concerning the details of the varying programs that myself and some of my coworkers, we have other mentors that specialize and do different types of trading and teaching and so forth. But in the last few minutes, any questions? Let's see. In the last webinar I gave 4 dates as turning points. June 22nd, 7/7, 7/31, and 9/19, September 19, and the 20th. Yes, that's still a valid pertaining. The other dates, I'm not sure who's asking the question. Someone's saying the dates of June 22nd, July 7, July 31st. I think those are, I think you're referring to the stock market. Yeah. August 1st, if you are referring to the stock market, my last one that we just passed, August 1st. Actually, it came in July 31st, but that's a Sunday, so August 1 was pertaining. Yes, so I would add that if we are referring to S&P turning points, the answer is yes. And the next one I projected is still 9/19 or 9/20, September 19, September 20. I'm getting a lot of confluence of cyclical cycle endings in and around converging and clustering in that September 19 and 20 period. For yes, so it is not a level in price, but a level or a point in time, and that is still relevant. I have about an over 90% confidence to expect change, or to simplify it, if we imbue the word trend change with a multi-layered meaning on or about September 19 or 20. Yes, that's still an effective date, relevant date. Looking back, did those dates and levels work out? You tell me. I'm being facetious. Yeah, you look at a chart, any major index, it was precise. You look at the top. Now, having said that, I've got to be forthright. Whether or not you or I or anyone out there in the world would have been able to exploit that information in a manner that ultimately, at the end of the day, represents an influx of revenue to your and builds your equity and supports and props up your equity curve, probably you would have, but not a guarantee. That's ultimately of greatest importance. That's the reason we're here from the practical standpoint in the real world. Clearly, I get that. I focus more on pure analysis and theoretical considerations today. At the end of the day, the analysis is all for setting us up and propping us up from a vantage point of higher probability, so we're better able to consistently, with accuracy and with reliability, identify value areas in a market. So the literal response to your question, yes, it was a perfect forecast, August 1st. Are all of them as perfect as that? No. However, I'm adding in, and I want to contextualize this. I was whipsawed last week. One of the conclusions I want you as a practical point of takeaway today. I am bullish the market right now, and because my next time point is September 20, the implication, and I got to be careful here, but it implies now there's a lot of assumptions embedded here. But if I were to X out in a perfect theoretical universe, in other words, if the price action of a system I were studying, a market, let's say the stock market, we're trading if it were in a vacuum and immune from all forces other than the amount of time, and that, even having said that, is not sufficient to properly model the real world, because it doesn't take into account the possibility that there may be interim time points. However perfect I forecast my September 1920 period point in time out is, it doesn't say anything about the possibility of, say, an interim number, a single or a multiple of additional turning points. All it says is to expect change, one type of which is the outright 180-degree shift of direction, where a market stops going up and starts to go down, or vice versa, let's say. But you start with the simple, and we incrementally layer in added detail, and we work towards the complicated, and we make the mid-course adjustments. In the same way, when they launch a spacecraft into space, they start out with basic Newtonian mechanics, but because the phenomena, we're dealing with three bodies, there are complications that occur that require mid-course adjustments, thus the retro rockets. So my big thruster analysis has projected for me a major shift in the character and the motion and trend direction of behavior of the stock sector in the United States on or about September 20, let's say. If in next week, tomorrow, the next day, the next hour, the next week, if at some point prior to that I see shifts, then I have to make adjustments, the mini or the more minor layered nuanced adjustments. But more or less, I have so much confidence in that, I expect that to be as reliable as the August 1st. But you look at any price chart to wrap that up, yeah, there was a precise, obvious top on any of the major indices on August 1st. So that proved to be a perfectly precise and accurate forecast. All right. Our levels worked out as per your analysis. Any afterthoughts? Let me get looking back, did those dates and levels work out per amount? Yes. Any afterthoughts? None other than what I just mentioned. Even though that it was a perfect forecast, it's not certain as to if, depending on your type of trading, if you're a short-term trader, day trader, intermediate swing, position, long-term investor, whether or not one would have profited. They are, of course, of greatest importance at the end of the day from a practical standpoint, but that would be my thought. There was an opportunity to profits, clearly. Whether you did or not, would be a function of other components and an entire alternate but complementary set of variables that we would have had to take into account, and your money management certainly being one of them. All right. Do I believe that there are certain time frames that are more favorable to trend lines in all markets? Clearly, everything I've said, folks, in a theoretical sense in today's presentation would have general across the board application and universally appropriate and applicable. Yes, however, that being said, when you go down to shorter and shorter windows of time, say down below 5 minutes, 10 minutes, for very, very hyper, short-term trading, you get into a realm of price action, white noise, much higher, much less degree of correlation, where the price action in the future is less connected to the present, and the present in turn is less connected to the past. It becomes much more random price action. You're really in a realm of Brownian motion, and you don't have time sufficient for the summation of the cyclical underlying cycle components to create a persistency of motion. And this is quantitatively determined by the Hurst exponent and a lot of the work by Hurst. And that's the most rigorous treatment, the Hurst exponent, depending on the amount of persistency or connection or correlation of the phenomena we're studying. So if I'm day trading, even though theoretically, because markets are fractal, meaning that there's a self-similarity of structure as you shift from one time horizon to another, yes, the scaling, the self-similarity, the similar mimicking of behavior at some point ends in the real world. It's kind of like, an example that's often used, if you were to look at the biggest artery coming out of your heart, the aorta, and then as you go down further and further from your heart and extend out towards the extremity of your limbs, there's a bifurcation, meaning a splitting up of the blood of the arteries, and so, but more or less it's a self-similar, but it doesn't extend into infinitely like it would in a mathematical sense. It's not infinite. Likewise, in markets, the scaling of correlation doesn't extend infinitely. So, as a practical note, if I'm day trading, and I haven't done a webinar on day trading recently, probably in about a year at least, but there are certain adjustments one would need to make. For the most part, if you're, let's say, if you have a cadre and a toolbox of tools that you use, oscillators, analyses, trend lines, candles, whatever you do, moving average, etc., whatever constitutes your system. If you are applying that system on a given time frame, whatever your average window of time is, you're in for a few minutes, a few hours, a few days, a few weeks, months, etc. Whatever it is, if you at any point shift your time frame, typically 80% or so of the tools and approaches and models you utilize are equally usable on different time frames. But when you shift down to very low time frames, you probably have to make some adjustments to account for the disassociation of price. There's very little, if any, correlation, and this is why it's critical on all levels to have good reward risk parameters, have 2 to 1, 3 to 1, etc. But even more so, especially when you get into behavior that's more random motion, and that's typically shorter time periods. It's not as if there's anything mysterious or why that is. It's just that there's not time. If you are by definition working in and out within seconds, hyper-frequency trading, there's insufficient time to allow the periods of summation for cycles to allow the more persistent motion. And as such, if one is focusing in that realm, you have to take that idea into account and adjust your strategies accordingly. That's all. Do I see correction before the year end? I assume, Sheth, you're referring to the bull market. Clearly, yes. Yeah, here's my thought, just in a very broad stroke here without detail. If I'm correct, if as an extension of the trend analysis and utilizing the stock sector in the United States today, right now, I'm talking real market, not theory, right now, if as a consequence of what I've just shown you, and if we had a turning point last week, August 1st, and market came to, we've got in the stock market, the market traded in a range, just on a practical note, having nothing to do with what the pure trend analysis is talking about, but the real world, in answer to your question, Sheth, or whoever's asking, from middle of July through the August 1st, the market basically trended in a sideways channel. The basis, the S&P 2169 was the upper level of resistance. That was the upper range. 2155 was your zone of, and so the market basically bounced for a period of about 2 weeks, middle of July through August 1st, in that range. Since last week, the market's been back and forth. I expected a great amount of volatility, a surge. I did not expect the degree or the surge that we saw. So that's why I got whipsawed. Now I am 90% confident we're going to continue more or less in a given trend. What trend? Higher into the next window of time, September 20. So the answer to your question, do I expect a correction? It could possibly be a correction that might commence on or about my next time point. I know that the fall from a seasonal standpoint tends to be not so kind to stock markets in the United States, again, seasonally. On the one hand, I also have to put that into context and reconcile that with the upcoming political election, taking into, I'm not oblivious to fundamentals, any and all information, fundamental, technical, quantitative, these are just different sources. The labels allude to and create a connotation of the source of the type of information. Information is information, that's all. So yeah, that's my quick answer. It's possible that the 920 point might mark the beginning. Clearly it could be a point of change, whether it would be defined as what you're calling, or however we're defining a correction, or maybe something of even greater import. Maybe it's the end of a generic bull market and the onset of a new generic bear. But clearly the literal response, it could be the start of a correction, clearly. Do I see a trend continuing? Yeah, through the next, what is it, 6 weeks or whatever, yeah, roughly between now, today, August 9th and September 20. Yes. What is my target level? I have not worked that out yet. Only because I'm still trying, I just in the last few days have determined, I'm trying to figure out where we go from here in terms of, are we still, to what extent is the market, which was in that consolidation of sideways trend, essentially. You look at any of the major indices, the Russell, the NASDAQ, the Dow, the S&P, the spiders, etc. You look back from middle of July, July 14 or 15, depending on which specific index you're focused on as a trading vehicle, let's say, you more or less moved in a sideways line. The more basic price action was really sideways, horizontal. So we didn't really do anything for the last 2.5 weeks. So we've just broken, first we broke down below, then we just in the last few sessions broken out above. So I'm still just trying to figure out with greater confidence, are we clearly going to move and make a meaningful excursion away from that range of consolidation? So I haven't yet, it's just a matter of, the price target is easy. I must first and foremost acquire what for me would be a confident level that in fact we're breaking and we're not going to revert back in mean regress to that range. But yeah, I don't have a price target. I have a run time, again, 6 weeks between now and September 20. Yeah, from time to time, folks, the Academy asked me to do a webinar. It's just trying to find topics. Someone's asking about it next time I do a day trading webinar. Yeah, there's an infinite number of ideas, but yeah, that I haven't done that in about at least a year or so. So maybe that's the next upcoming soon. So stay tuned. When you get invitations, guys, I may soon be doing, just because I'm often hard pressed to think of a new topic, because I do my analysis and just trying to present ideas that on the one hand are going to be somewhat provocative and helpful and interesting, but at the same time somewhat, if not perfectly, relevant to the current events, the current market scenario and situation. Yeah. So yeah, stay tuned, and that would be it. Since I haven't done one on intraday activity and trading in particular, I may do that in short order. Very good, guys. Again, it's been a pleasure. You have the contact information. Peter Newman handles any details or questions. And if you'd like, we are recording, so I'm not sure if they automatically send out copies of the presentation to everyone. If you get it, great. If not, and you have questions about acquiring such, just you have the contact information here. As always, until next time, wishing you a great day and profitable trading in the days to come. Until then.